Hey everyone, it is Evan here from the Trade Risk on Friday, February 21st, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and finish off looking at some sector analysis. So lots going on this week. There was lots of action. We're going to jump right into it with our market technicals dashboard here. You can see that it was a rough finish to the week. All of the major indices closing down firmly in negative territory here on Friday. And take a look at the Nasdaq 100, notably here, down almost double any of the other major indices at almost 2% on Friday. The 5-day change numbers all firmly in negative territory as well, and we are now below the 10-period simple moving average across all of the major indices as well. So what a difference a week makes. If we scroll down and take a look at sectors down here, you can see biotech, utilities, materials and utilities at the top 3 of the list. And on the downside, we have industrials, we have technology, and semiconductors underperforming the rest of the sectors over the past 5 trading sessions. In terms of major markets, we got the VIX up here popping 25%, followed by silver and gold. And on the downside, we have emerging markets and the S&P 500 and China in the bottom performing markets over the past 5 trading sessions. So let's dive into the charts now and take a look at what went on here, if we can make some sense of this action. So we're starting with the S&P 500, we're starting with a weekly time frame, and we're looking at the cash settled market. Now, if we zoom in here and take a look at this week's action, you can see that we attempted to continue this trend. We attempted to make new highs here earlier in the week with this little bit of a wick over last week's trading candle, but you can see we ultimately were rejected at those highs, and we moved negative and closed at the very lows here of this week. So we're back down towards the bottom end of last week's trading. Notice we're also starting to lose this trend line here, this channel that we've been in since October. Again, this isn't drawn so precisely here, so I don't want to get too specific on the actual break here, but we're back down to this general slope that we've been grinding higher in. And very probably more important is actually this 33, call it 36, 33.30, this 5-point or so band that we broke out from last week is what we're now kind of testing heading into next week. We closed right at this prior all-time high point, the prior breakout point, and this is where I think things get a little interesting heading into next week. So if we fall down to a daily chart and just take a look a little bit closer at this action, so same exact chart, just looking at a daily time frame now, you can see we're closing right at this upper, this channel here that the market was in. Remember, we briefly sort of broke down below it back on the last trading day of January. We quickly recovered it. We went sideways, we broke out, we consolidated, and now we're starting to pull back and almost roll over a little bit. So heading into Monday, I think we have an immediate test of interest to see how this market A, opens up for the new week, and then B, sort of handles this general area here, because just 2 weeks ago we broke out and things were looking pretty good, and now we're back to this breakout zone and essentially retesting it. So the bear scenario at this point would be either some type of gap down or some type of just continued move lower. We could gap up, but if ultimately we thrust lower and close below this 33.35 area, which was the prior highs, I would say that that is a short-term sort of bearish catalyst or event or technical kind of of technical significance in the short term. So however you want to interpret it, I would say if we get follow through below where we're currently at, I would say that puts us at least in the short term sort of penalty box, and in fact opens us back down into this range here. And I would say even all the way down to 32.16, which from a percentage basis actually isn't that far away. It's about 3.5% away from where we currently closed. But if we start moving back down into this old range here, then I would say risk opens up down to around 3,200 to see if this is still going to hold, which is where we found support back in late January. So that's sort of the very short-term look here at the S&P 500, a pullback, coming back into this shorter term breakout level. Let's see how the market reacts. If we start falling back below this range, then we have some risk levels to pay attention to down here. If we switch over to this chart, which is certainly a little busier, we have some more kind of near term acute levels you could start to pay attention to as well. But effectively now, we have our new sort of highs drawn up here around 33.89 down to 33.31, which is where we closed and where we broke out from. And then we have effectively this range that we were in for most of January here as we traded, as high as around 33.30. We pulled back to 3,200 and then danced around and ultimately broke out. So that's what we're looking at here for the S&P 500, some near-term technical damage. Again, time frame really matters here. So if you're a shorter term active trader, this might be meaningful action the way this week developed here. And you may be, reducing exposure, perhaps getting short, putting on hedges, whatever the case is. If you're a longer term investor, position trader, trend follower, then, there's basically been no damage to speak of at this time. We essentially just have a down week in an overall uptrend. So you have to absolutely, kind of know where you live and how closely you want to monitor this action. But certainly here, a little bit of short-term pullback. And really, I think the S&P 500 got away pretty much unscathed this week in terms of creating too much technical damage. I think it's the Nasdaq 100 that was most interesting this week, and it's particularly Friday's action, because when we look here at the Qs, this has been the leadership for the market now for some time. And if we look at how this developed this week, I would say that this is a more meaningful and sort of ominous looking kind of session here. The fact that we are now sort of, following through to Thursday's weakness with more weakness and doing it on some pretty heavy volume. So about 200% volume, breaking below prior multi-day lows, breaking below and out of the bottom of this channel here that it's been in since December. And this, I think, just has a more sort of ominous look to it here, and especially given the fact that it's been our leadership group. So I think the cause for concern primarily here would be the Qs. The S&P 500 is sort of retesting a prior breakout zone, hasn't had a lot of technical damage. Qs here, I think, are a little more susceptible. And, if this does get follow through, if this doesn't get an immediate save next week, then again, I would start to look all the way back down to the January lows, which is about 5% away in the Qs, around 220 or around a little under 220 for the Nasdaq 100. So those are some levels to consider. Nasdaq, I think the bears can hang their hat a little bit closer on that. And the Russell 2000, honestly, an index that you would expect to really roll over hard this week because it has been underperforming, really didn't flinch all that much. In fact, it's still just kind of comfortably moving sideways here. So I don't know if that means we're going to see some more rotation into this group. We talked about in last Friday's video some potential rotation into the Russell, maybe biotech led, and biotech did outperform this week, so there was maybe some further kind of evidence of that, but we still just haven't seen a resolve here yet. So we're going to just kind of wait patiently to see which way this 6-7 day range resolves next week. Obviously, if we start breaking down lower, then that's going to put more pressure on the market. But, if we do get some type of miracle breakout here over 169 next week, then, maybe it's Russell 2000 comes to the rescue. We'll have to see. It did still close down this week, but only 0.5%, so quite minor compared to the Nasdaq 100, so to speak. So that's it. That is the, kind of top level developments here in the market. I think what we talked about in terms of time frame matters, but, there's certainly some things to take notice of this week, particularly in the Qs. And then, of course, what happened in commodities and some of the safety havens. So let's get over to that. We talked about this in our video on Tuesday, but the TLT started to make a run for it earlier this week, and in fact now it is back up and challenging these prior highs here from August. This breakout or this consolidation of about 3 weeks in the very short term resolved in a breakout to the upside. You can see we had a 2.4% up week here for TLT, and you know, when we have safety assets running like this, bonds, rotations into treasuries, it's generally sort of, you know, at least historically is considered sort of a risk-off sort of rotation or trade. So if we continue to see strength in TLT, maybe that, you know, bond market sort of leading here as well in terms of some future equity weakness to follow. So TLT, meaningful sort of breakout here getting underway. It's a little stretched in the short term and rejecting off of these prior highs, but still, you know, bulls got the momentum here as they work their way back up to the upper end of the range. And if we look at gold, gold started to run early this week as well, posted some charts on social media and made some updates in our midweek video, but gold resolving this about 5-week range or so to the upside, and unlike TLT, it's already back over all of the prior supply. So it's in fact making multi-year highs, I think 7-year highs, not quite all-time highs, but gold continuing this trend here. This is a monthly view, so looking pretty nice on a longer term basis for gold as it continues to sail sort of up and to the right. Some good momentum following that trade as well. Silver also on this list is some nice momentum this week. If we go to a weekly chart of silver, you can see we were up 4.35% and finally starting to clear over that $17 area. So silver, maybe even some little inverted head and shoulders pattern if you like looking at that. I'm not sure if that meets the requirements, but you do have a breakout underway for silver, and it's a week one sort of breakout in a potentially big pattern here. So if this does get follow through, if this does get some legs behind it, then this you know, certainly has room to run. So silver, let's pay attention to it now. We talked about it on Tuesday as a day to take notice, and I think now we have a week to take notice in all of these markets, safety markets really, that started to break out. Now if we finish off with energy here, energy did still fare decently this week. So oil specifically, the commodity, you know, if we go down to a daily chart, still doesn't look all that impressive just given the move it had to the downside to start off this year, but it is rebounding. It is holding at a very important level around this 1050 level, which has been where buyers have stepped in for USO for over a year now. And as long as that holds, then we have at least some short-term bottom to potentially trade against. If we look at natural gas on the week, it was up 3%, but you can see it did not close at highs. In fact, it got a little bit of rejection here off of those prior highs. Really looks like it's kind of developing in this new range now of, you know, call it 13 and change up to about $15, and it looks like it's trying to move to the upside. It's trying to get that breakout, but still having a little bit of trouble really kind of you know, pulling through some of this overhead supply. So that I think wraps up all the major markets there. I think we have lots to think about, lots of movement going on this week, so certainly be a fun you know, weekend to chart some of those longer term moves. Let's jump in now to some sector analysis. Let's take a look at top performing, bottom performing sectors here, and biotech was the top performing sector this week. It was up almost 1%, and basically you can see it's just sort of glued to resistance right now, and this has sort of been one of our kind of feature trade ideas, or a sector that we've been paying attention to because it hasn't gone anywhere for about 2.5 months now. Since the strong fourth quarter run up in 2019, it's basically gone sideways. It hasn't participated most recently. It's just moving sideways. And again, I think this perhaps could correlate with you know, that small cap Russell 2000 catch-up trade. We look at like sort of the XBI here, which is the equal weighted biotech ETF, and you can see it's basically the same thing here, mostly sideways through time for the past 2 months and kind of bumping its head against resistance. So be interesting to watch XBI and IBB next week. It is an actionable area of the market just given the consolidation, but it is a high beta you know, area of the market. So if we are going to see some increased selling pressure, I can't imagine biotech holds up, and really kind of stands alone. That would be fairly surprising to see if we are going to see selling pick up and selling pressure increase. You would think that biotech is going to kind of fail here at resistance. So we'll have to see next week how this market again opens up and reacts to some of the selling pressure we saw here on Friday. So that's biotech. Number 2 here is utilities. As you might expect, a little more of a safety tone to it, of course. It's had a monster move for this year as it basically just pulled away from all prior resistance levels. It's trading just under its all-time highs. I mean, utilities still in a very strong trend and look good. And last but not least here in the top 3 was staples. Again, makes sense. Staples, safety. This is where sort of the risk-off equity exposure tends to flock to these sectors of the market. Now, on the downside, it's semiconductors. Semiconductors have been a strong leader for us, and they were the biggest underperformer this week, down almost 4%. Again, they've had such a good move that this chart, even a 4% move doesn't look horrible. It certainly isn't the most pleasant looking chart out there, but you could make a case where if you take a wider perspective view on this, then perhaps we just have, this wider range that's still sort of in play here from, again, January lows up to recent highs. You could effectively call this an attempted breakout of these highs here from back on the 24th. So we briefly tried breaking above it this past week or so, and then we failed. So if we move back down in here, maybe that is the upper level consolidation that takes place here for semiconductors. Again, we'll have to see. It's not a prediction, but certainly in the short term, looks bearish with that volume coming in. Seems like it could come back down into the 140s, but maybe it's an opportunity in the bottom end of that range. XLK technology. This is number 2 here, and underperformers down 2%. It's going to look very similar to the Nasdaq 100. You can see high volume sort of thrust down to the lower end of this channel. Hasn't quite broken down below this channel, but again, I don't want to be too specific with it. Generally here, the high volume, the thrust off of this trajectory here is usually just not a very pleasant sort of development here. So if the bulls can't save this quickly, it does seem like this can open itself up to more downside. And last but not least is industrials down 1.37%. This one here, again, if we zoom out, this has been just much more of a slower kind of grind higher. So this one looks pretty different than semis or tech or some of the other high flyers. So this one here, I mean, the bigger goalpost would be around $82. If it can stay above $82, then really there hasn't been too much technical change here. But underperforming in the short term, maybe it's even an opportunity. We'll have to see. But XLI down 1.37% over the course of this week. So that's it. That is the weekend recap. Lots going on. Hopefully everybody survived, made it through the week. A little bit of volatility, a little bit of changing of guards there, safety moving. So hopefully we can make those adjustments, measure those levels we talked about, and sort of act accordingly. So that's it for me. Thanks so much, as always, for tuning in and watching. You can subscribe on our YouTube channel or follow us at The Trade Risk. Have a great weekend. We'll see you back here on Tuesday of next week.